Welcome to today's webinar, Practitioners in Factor Investing Fundamentals, Portfolio Strategies and Assessment, hosted by CFA Institute. It's a day for you, but thank you so much for your patience and keen interest. So first and foremost, a very warm welcome to our audience from around the world joining us today for discussion on a very engaging and interesting topic. I am Pankaj Sharma from CFA Institute, and I will be the moderator for this webinar. I lead capital markets policy for CFA Institute in India, and in my role, I am responsible for advocating policy positions on issues that affect Indian capital markets and its stakeholders, and across a broad range of subjects. Before I introduce our speaker for today, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including the Q&A, 45 minutes for the presentation by the speaker, and then 15 odd minutes for Q&A. We'll be leaving enough time for questions, so please feel free to submit your questions and we'll try to take as many of them as possible. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. We immensely value your feedback, so please complete the evaluation survey before you sign off today. Now it's my pleasure to introduce our speaker for today, Mr. Kshitiz Jain, CFA and FRM. Kshitiz has played a pivotal role in establishing the fixed income trading at Shriram Finance. And before joining Shriram Finance earlier this year, Kshitiz was responsible for spearheading the direct equity investing vertical at CAGR Wealth. Factor investing has been an area of keen interest for him for the past few years, and he has managed fundamental and factor-based investing strategies at CAGR Wealth. Kshitiz holds a Master of Business Administration from IIM Bangalore and a Bachelor of Technology degree from IIT Roorkee, holder and financial risk manager. He is also an active volunteer for CFA Society India, and I would like to add here that over the last couple of years, I was fortunate to get multiple opportunities to interact with Kshitiz, and I'm deeply impressed with his diligence, discipline, commitment, and highly methodical approach in whatever he does. Once Kshitiz has taken a task, there is no doubt that it would be delivered no matter what. I can go on and on, but I know that they're delaying the proceedings here. So a very warm welcome to Kshitiz, and it's a pleasure to have you with us today. And I'm sure that our audience is eagerly looking forward and will have a great experience listening to you. So without further ado, over to you, Kshitiz.
Hello, everyone. Thank you, Pankaj, for those kind words. The experience of working with you has been equally incredible. So let's begin. So today's topic is largely around factor investing, and this is more of a, I would say, an introductory webinar, more about fundamentals. How do we look at factor investing? And then we'll look into the aspects of multi-factor investing, and then we will look how one can build their own factor investing strategies, at least how they can think about it. It's not really building. Maybe we'll take a workshop, but how at least you can start thinking about building your own factor investing strategies, and then there is a simpler way to how to actually live run your factor investing portfolio and to track it using simple tools. So that's all we will cover here. To begin with, let me first have the disclaimer out of the way. The views and opinions expressed in the webinar are my own and do not necessarily reflect the official policy or position of any organization, employer, or affiliated entities. They are intended for educational purposes only and should not be construed as a professional advice. Now, let's start with the webinar. As I said, largely 4 agendas. Let's first touch on the facets of factor investing. Then we will go about doing the introduction to multi-factor investing and why it is something which has become very popular. And then we'll look at how do you go about designing your own factor investing strategies, and then how you can run your own strategy using live data. let's start the on the first agenda. What is factor investing? So to begin with, let's look at the origins of factor investing. The simple idea of factor investing came from the fact that in modern finance, a lot of things have been the research has been done around what drives a stock return, right? So that has been so that anything which a group of where you can say that any characteristics which a group of stocks has and can be related to its excess returns for that group of stocks as compared to the market or for other group of stocks can be considered as a factor, right? So over a last few decades or so, I think a lot of I would say more than 1,000 factors come out. A factor can be as simple or anything which let's say a factor can be as simple as let's say anything which has a Gujarat stock which has a Gujarat in its title, right? That can also be a factor, and it may explain return and risk for that group of stocks for a small period of time. But to an attribute to be considered as an investment factor, it will only and only if there are four characteristics, right? Which is persistent, pervasive, intuitive, investable, and robust. I'll come to that later. Let's first look at where it all began, right? So the first introduction to factor investing came with the KPIM model, which was like the first one single factor model, which had only had the market factor as one of the factors, which was beta. Like this came in somewhere in 1960s. Then came the next evolution of it came with the three-factor model of Eugene, Farmer, and French, and they came with value, size, and the market factor, right? So that was the three-factor model, so as to say. And they also said that market beta only explains around 67% of the returns in a stock or a group of stocks. And then from there on, there have been multiple studies and been done on the factor, and we have seen a lot of multitudes of factors have been discovered. Some of the more common and accepted factors is what we will cover here, which is largely value, size, momentum, low volatility, dividend yield, quality, and growth and value are more growth is somewhat of a less accepted factor, but still it's one of the investment factor. uh, and now let's come back to the fact that why only these factors or a set of factors are considered investment factor. Let's say the to begin with, a factor should be persistent, which means that it should be the factor should have a consistent performance, or it should have an outperformance across time periods, right? It should not be like a factor cannot be considered an investment factor if it only worked for a decade or for 5 years only. It should have the data should suggest that that factor is applicable across decades, across time periods. When I say pervasive means it should be available not only for equities. It may be applicable across asset classes, across I would say even geographies. And then when you say intuitive, there should be a reasonable explanation, right? There should be a logical explanation for why that factor is outperforming. And it should not be a black box that won't be considered a factor. And then when we say investable, right? So the factor should there should be a like we say investable. So basically means the factor should be able to outperform with the trading cost also. Like if you're trying to invest and make a system out of it, the factor should not be arbitraged away. So it should be investable. And robust means it should not have a very narrow definition of that factor. So like for example, value factor will not be considered as an investment factor if the definition only says that it only works with price to book as a ratio, right? That won't be considered as a factor. It should be like we have what the definition of value factor is, that cheaper stocks outperform highly priced stocks in the long term, right? That is the definition of value factor. And that should the factor should have a broader definition, not too specific to a single ratio or a very narrow definition. So in that sense, these are the five 5 or 6 factors, which if that is applicable to a characteristics, that would be considered as an investment factor. Now, coming down to what are the definitions of various factors, right? So value is very simple, I think, and it is one of the most accepted and most, I would say, factor with the most cult following, because it got popularized with Benjamin Graham in 1930s, and then we have Warren Buffett and a few of the most reputed investors across the world practicing value investing. At least they began with practicing value investing, which is the cheaper stocks will outperform higher price stocks in the long term. And obviously, these can be captured through various ratios, like book to price, I've already said, earnings to price, just sale, earnings to sales and cash earnings, net profit. All of these can be considered as a parameter to capture value. And when we say low size, I think low size is one of the factors which have been used by investors for a long time now. So it's which says that the smaller firms will outperform relative to their larger counterparts, and largely this is defined by their market capitalization, and low size can be dependent on which market we are talking about. And then the third one is momentum, which is which just says that if the stock has done well, a group of stocks have done well in the past, they will outperform the stocks which have not done so well in the near past. So if something has done well in the near past, it will continue to do so. That's the definition of momentum, and that's how this factor is defined. And it is defined using 3 month, 6 month, 12 month. And sometimes what happens is out of these, when you say a 12-month, I will capture it using 12-month rate of change. The last 1 month is excluded because of the reversible tendencies. And there can be other methods to do it, to capture momentum using technical and analysis and all other methods also, moving averages and stuff. Then the fourth one is low volatility. That is one of the most counterintuitive factors. All are academic, and in at least the initial stages, what we read is that for a higher return, you need to take higher risk, while low volatility itself says that if you buy stocks which have lower volatility, or will outperform the stocks which have higher volatility. So which is quite counterintuitive, and you can capture it using standard deviation, beta, any of these parameters you can use, where basically you have to say that these set of stocks have lower volatility. And if you make 25 basket of these stocks, and make a 25 basket stocks of with have a higher volatility, there are there is the chances that in the long term, the low volatility stocks will outperform the higher volatility stocks, and that has been seen across various markets and decades also. And it became very popular especially after the global financial crisis. Dividend yield is very simple. I think the stocks with higher dividend yields will outperform the stocks with lower dividend yields. And that is very captured with using dividend yield. And quality is one of the fundamental factor. It is the definition of it is very loose in that sense. There is no academic definition to it. It's just defined by a company or a group of stocks which have robust fundamentals, their balance sheet is robust. It can be captured using quality of their earnings, stable earnings growth, other quality metrics. And to be fair, they can be captured using a lot of fundamental factors: ROE, earnings stability, dividend growth stability. On the other side, there is growth, which is a kind of a countermeasure to value, which says that the companies which are growing at a faster clip, at least their earnings are growing at a faster clip, have a higher prospect than the companies which are not doing so much. And growth has done well in India for a while, for few decades. And then we saw at least after 2020, we saw value again coming back, and the lower price stocks have done so well, and then we'll come to the why such cycles happen in factors. Now moving on, what we have captured till now is what is factor investing. Uh, uh, Now let me talk about why factor investing has become so popular across the globe, right? So the one of the major reasons why factor investing has become so popular is that uh, uh, obviously a lot of all of these factors which have been identified, they have been able to outperform the market weighted capitalization index, right? If you see this beautiful chart from MSCI, you can see all from December 1999 to December 2022. If you would have mapped the annualized return against the annualized risk, the most of the factors, all of the factors, the market weighted capitalization index, minimum volatility is actually done very well. All of them, right? Quality, momentum, all of them has done well. But what has happened and why it has become so popular, the return is one of the reasons. The other major reason is that with the advent of all these I would say investment tools and technology, it has become easier to actually implement these factors into a systematic and scalable investment portfolio, and to actually harness all these factors using various tools that has become very easy, and that's the reason it has become very popular across the globe. In India, obviously, it is gaining popularity, but across the globe, these factors have become quite a staple now. And now the analyst all and so there are two things obviously to this. The analysts initially started using to attribution for a investment manager's performance, to attribute which factor is actually driving his performance, or is it only the style tilt of that investment manager driving the returns, or is it actually is stock picking within that factor which is driving the return? That is where the initial usage of factors came in. Then once the factors were identified, the investment managers or the in everybody in this market realized that if a certain characteristics outperforms the broader market, why don't actually use that factor and invest using that? And that is where all these factor ETFs and even active fund managers are using factors now to a certain extent to enhance their returns. Uh, Moving forward, as we said, let's understand why certain factors outperform, right? There should be a logical reason, as we said earlier, why certain investment factors have actually outperformed. So what explains extra factor return? So there are two ways to look at it. One is that either we can look at it like from a systematic risk perspective, which says that because you are trying to select all a set of stocks with a certain characteristics, you are actually taking a higher risk, and that is actually leading to your higher return. While the other way to look at it is that which is basically there are behavioral patterns which are being harnessed using certain factors. So for example, value, there are studies which says that because you are selecting a value stock, you are most likely you will be selecting which is cheaper, and the set of stocks are normally stocks which have a higher business risk, business cycle risk first, so as to say. So they are more and especially value and size, both of them have that tendency that smaller companies or value stocks which will come in have a higher risk of a recessionary. If a recession is hit, they have a higher risk of underperformance and their financials going for a toss. So that is one thing which explains that there's one part of the explanation saying that because you are picking all those stocks, you are actually taking higher risk, and that is why the premia or that excess returns is coming to you. All the others hand, the behavioral view to it is that so what happens sometimes is that there is an error in expectations. So what happens is investors in general will extrapolate the past returns quite a bit, and companies which have done well in the past, most of the investors will expect that they will continue to do at that same percentage year on year, and that actually leads to them being overpriced, and then and then because they are overpriced, they'll underperform in the future. While the stocks which are not done so well in the past, the investors don't not easily able to identify if the cycle is turning, or those stocks now probably will do well in the next cycle. Those are the things investors are pretty late to identify, because the market as a whole has a tendency to extrapolate. Similarly, uh, same on the size side also, a smaller company, if it is not doing so well, market actually starts discounting them at a higher rate, which then they should actually, and suddenly the smaller companies become very I would say cheaper, because the market will completely ignore it, and then suddenly you will find that there is outperformance because of these stocks being picked. Now, similarly, for momentum, I think again, there are studies saying that if there is momentum, or the set of stocks which come into momentum have a higher business risk, and those are more suspect. Those companies are more suspect to recessionary, if a recession is hit in the macroeconomic scenario. And because you are buying something in momentum, there is a tendency that there may be sharper correction in that stock. So you are actually taking higher risk, and that's what you are being paid for. While the behavioral way to look at it is that you are actually being paid because markets underreact or overreact to most of the news. So when a good news starts trickling in, markets are generally will be at least to begin with very gradually accept that, and then once it gathers pace, markets will have a tendency to actually keep on overreacting to it. And also the market structure also plays a role. Most of the I would say the management do not have the do not will probably will be sharing more or will talk about more positive news than they are, or maybe more forthcoming to share positive news than the negative news about the company, and that causes all these underreaction and overreactions in the market. Especially again, low volatility, obviously there is no systematic risk explanation to it. We are actually taking lower risk stock and lower volatility stocks and still outperforming. The tendency is more about lottery effect or overconfidence per se. Basically, market has a tendency, or market investors have a tendency in general to believe in their own skills quite a bit, and the stocks with higher volatility, they believe that they are able to predict with a higher confidence than they actually can, and that leads to overpaying of stocks, overpaying for stocks which have higher volatility, while they keep on ignoring low volatility stocks which have stable earnings and year on year. And that leads to kind of a, I would say, bias towards high volatility stocks, and because you are overpaying for it, the returns in future go down. And dividend yield is pretty simple to understand from that perspective. Again, similarly, something which is paying a higher dividend, again, market starts discounting it at a higher rate, and they kind of keep on ignoring those stocks, even if they see higher dividends being paid. So yeah, so there are both sides of it. There are explanations saying there are higher systematic risk is being taken in certain stocks, and that's the reason you are getting paid for, or there are behavioral reasons for it. I personally believe there are more behavioral reasons for the factors to outperform, and or the market structure is such that these factors have become so prevalent in across asset classes also, not only equities. uh, and let's move forward. Let's look at how the factor performance actually happened in India. So over the last decade, I've actually selected BSE factor indices to showcase Now we have also have mutual funds tracking a lot of NFT factor indices and even BSE indices. And if you can see, since the launch of these indices in 2016, all of the factors have actually outperformed. If we look by August end, all of the factors have outperformed Sensex. And size is obviously reflected by mid and small cap index. While low volatility, the momentum has done extremely well. While others like low volatility, enhanced value, quality, size, all of them outperform. But if you can see, not all of them have outperformed, not all the time. You see, both size and value were not doing so well till the time before COVID, from 2016 till the COVID hit. And then post that, post COVID, both of these factors have started doing so well. And we will see if this is something which is prevalent, or is there any reason for it in the presentation going forward. Now, but the obvious question looking at this chart specifically is that why not just hold if the momentum or these factors outperform, why is not everyone chasing these factor strategies? Why the money is not still going into broader indices? Why not everybody is investing in factors? So the simple reason is that I would probably like to all of these factors have unique cycles, right? They are very cyclical. If you can see, they're not a single index apart from, let's say, value. I had a 2 year, which is what the best performing best performing factor, right? And but if you look at value in 2022 and 23, it was the for a 2 continuous year, it performed well. But similarly, again in 2018-19, it was the worst performing factor. While Sensex was giving positive returns, for both these years, value was given negative return. So not, any of these factors is not a free lunch, in the sense that you will have strong cycles, which will with all of these factors, uh, and uh, uh, and because there are cycles, what happens is for institutional investors to hold any single factor, it becomes very difficult, or for a retail investor also. Specifically for our institutional investors, but also for retail investors, the mostly we know anecdotally that investors don't have the patience or a longer horizon, right? So there is, for institutional investors specifically, there is job risk, right? So if you are managing money for clients, or for or you tend to have a shorter term horizons, and clients do not have that patience to hold on to underperformance. Like, for example, if somebody is doing only value, there have been years to at least he has underperformed quite a bit for in 2018-19, and if he was doing only value, that person would have underperformed. And that's the reason we will see how we can probably look at some solutions to it going as we move forward. But this is something which I want to quite drive home quite significantly, is that none of these factors outperform all the times, and there can be periods of underperformance and long periods of underperformance. And that's one of the reasons why they keep outperforming, because they the because nobody is able to sustain through the, or not nobody, I'm saying a larger public is not able to, or larger institutional investors or retail investors are not able to sustain through those periods of underperformance. So now, what is the way to actually invest through factors? So one is obviously, like we said, let's have a longer term horizon, right? So one is that way to look at it. Second way to look at it is that you can actually time all these factors, which we will see is very difficult. And I have actually personally not seen much success and much academic studies about it. There are few studies which say trend following may work on factors, but still, I have not seen. I think BlackRock has a ETF in US which says which that where they try to time the factors, but there not much success is being derived out of timing factors. It become very difficult. The third is that you probably try to combine factors, and that is where we will come to multi-factor investing. And now let's look, like I said, all of these factors, somebody has actually tried to time these factors. So there must be some characteristics where we can actually try to find when a certain factor outperforms, right? So uh, so let's look at this incredible chart from MSCI. This study is being done by MSCI. What they did is they divided this study was done from 1975 till 2016 data, and what they did is they divided the macroeconomic scenario or macroeconomic business cycle into four parts, which was sharp decline, moderate uptick, and sharp uptick. Now kind of uh, uh, captured how various factors have performed and tried to club all those factors into three broad categories. So one of the categories was defensive factors. So by the name itself, it says defensive. Basically, these factors outperform other factors when there is a decline, sharp decline or a moderate decline. So you can see volatility, yield, and quality, and quite intuitively also, right? Low volatility, yield, and quality stocks will do well because you're trying to capture companies which are in low volatility, which are very stable in their performance. Yield, obviously, something which is a higher dividend paying yield company will have a higher balance sheet strength, and that's the reason they're generating cash, and that's the reason they're paying out dividends. Similarly, for quality, you are actually selecting companies which have a higher fundamental strength. So these are intuitively also you'll understand that these are the kind of factors which are defensive, and they tend to do well when, or at least they tend to outperform other factors relatively when there is a decline in business cycle or macro environment, or a moderate decline per se. One of the factor which is momentum is persistent, which does well when there is stable economic cycle. But so as to say, momentum does well across other times also. It doesn't do as well as other maybe defensive factor in at times of decline, but still it kind of has a have a it does well across various cycles, even in times of moderate uptick. Sharp uptick, it has not done so well, but still it kind of at least not under it doesn't meaningfully underperforms in times of sharp uptick also. And then there are two factors which are pro-cyclical, and we will understand, as we said, that these are the two factors which are also impacted by business cycles a lot, is value and size. And these are the kind of stocks which we will try to, which cheaper stocks, right? For example, that's why I said after 2020, when we saw the macroeconomic scenarios shift, and we saw a lot of business cycles being supported by government, or by government spending, or the cycle itself turned post that, and we saw value and size, both of them doing so well. In India also, like we saw here, we saw both of them were not doing so well till 2020, and when the cycle turned post COVID across the world, when with the central banks cutting rates and governments also doing fiscal spending, we saw a sharp uptick in both value and size. And that kind of we can see that, and when there is decline per se, we saw low volatility and quality doing well before 2020, and they have not done so badly, at least after that also. But we but at least outperformance will come in when there is a sharp downfall in the market. uh, so now let's look at, so one is, obviously, you can time. There are three ways, as I said, to actually do factor investing. Is that one is, obviously, it's a very cyclical. If single factor portfolios are very cyclical, so there can be periods of underperformance. Like we had value was underperforming for a decade before 2020, across the world, not only in India, across the world, value had a underperformance for a decade, and then post 2020 it has come back, and similarly growth would have gone the other way. And so the reason, obviously, either you have a very long 15-year or so of a long term investment horizon, which is very anecdotally we know that institutional managers or for retail investors also, that period of horizon is not there, and nobody has that patience of to persist with underperformance. Secondly, is that you can time these factors. So obviously there are certain studies which they've tried to identify what may drive certain factors and across various scenarios. But this is very difficult in the sense to actually even identify macroeconomics in cycle is difficult. And after that, then you try to time those factors using that macroeconomic cycle. uh, there are chances very difficult to do that. So and not being done very successfully across markets by not by a lot of not at least not in the general larger segment of the public. There are obviously there will be some hedge funds doing it, on, like I said, BlackRock has one active timing factor timing ETF, but I've not seen it to be very prevalent. Thirdly, and which is the easiest, at least in my view, is that you try to combine 2 3 factors and see if they can have a very stable return, or at least the cyclicity of this performance can be reduced. And that's where multi-factor investing came in. And we will see why it has become why we see that there is a benefits of combining 2 3 factors, right? So let's look at the introduction to multi-factor investing. So how can we improve? So the way to improve, and you can see largely what happens is that all of these factors is, apart from quality and low volatility, have lower correlation with each other, and for value even has a negative correlation with other factors, which makes it incredibly useful to actually combine these two, probably combine value with other factors, and make it and use that as a combination to reflect your outlook, right? Reflect your portfolio, right? So if you combine, let's say, momentum or value, quality, volatility, value, there are more than then you have a negative. You're combining two factors which have a negative correlation. So your cyclicity of your performance will go down. And apart from that, what happens? One of the important things is that there have been studies which been done which says that the correlation of these factors still continues to be all these smaller small low or negative even in times of crisis, while the asset correlations, as we have seen in the past crisis, actually goes to 1. So that way they are very incredibly powerful if you can have two styles which have a negative correlation and still hold those negative correlation up even in times of crisis. So, and how have these factors, multi-factor indices perform? Let's see. So if you see, this is a interesting chart from S&P, and there are so let's say when we say combine factors, there are 2 ways to do it, right? There are two ways to run a multi-factor model. One is obviously you can combine it using funds of funds. So you take certain one ETF value in it, value characteristics, right? So let's say you buy one ETF which has value, one ETF which has momentum, right? And then you run it like those two 25 stock baskets independently and look at them as a portfolio. So overall your portfolio would be fund of fund, which is reflected by, in this chart, which is reflected by QVM index of indices. So what they've done is combine quality, value, momentum, and 3 of these indices independently being done used as a portfolio. Now the other way to look at it is, so this is basically a fund of fund approach. The other approach is that you try to actually combine these factor characteristics at the time of portfolio creation and select stocks which have either which have all 3 tendencies. So you kind of give scoring to various of each stock, to, let's say, it's a quality characteristics of this much, value of this much, and momentum. And then whichever stock has the highest score, combined score, will become part of your portfolio. And both of them have done well. As you can see, both index of indices have done well as compared to market. And also the I would say the portfolio creation at the time of stock selection at the time of portfolio creation using factors has done even better. And this is something which I also believe, at least there are studies to say both sides, but I would probably, at least I personally run my portfolio using portfolio creation at the time of using factor investing at the time of portfolio creation, and to select stocks which have both the characteristics. There also there are ways to do it, but still, but the easiest way, obviously, for an investor to start is funds of fund. Just pick two ETFs which have one value and one momentum. But the challenge, at least what I feel, is that what happens at times is that once you've selected two independent indices, what may happen is that your exposure to both the factors may go down quite significantly, because you're not looking at momentum while picking the value ETF. What may happen is those companies may be, they are cheaper because they have not performed for a while, and you may select stocks which have low momentum, and that may bring down the whole the exposure to momentum index for the complete portfolio quite a bit. While if you are trying to select stocks at the time of select stocks basis using factors at the time of portfolio creation, you have a much higher score and exposure to all the three or four factors or two factors which you are trying to identify, and may have a higher exposure to that's my personal belief. There are studies saying both of them at times work, and at least I believe the other better ways to use it at the time of portfolio creation. Now, moving on, and I think the one way to, how do you look at designing factor investing strategy? So first, let's look at how investing strategy would be defined, right? So first of all, you will define your universe, right? Whatever way there are, out of the 4,500 listed stocks in India, define your universe through market cap or volume, or through whatever you not invest in penny stocks, or whatever way you want to define, you will define your universe. Let's bring down that universe. Once you have defined the universe, you define your entry rules, and this can be fundamental, price based, and this is for any investing strategy. For a fundamental investor also, he'll have some at least through his heuristics or whatever, he'll have some criteria or checklist which he will try to have as an entry rule. And then you have to identify how much, once you've decided that these are the stocks which I will buy, how much you will buy. So that is very very important. And I would say probably out of all the five things which I am listing here, one of the most important thing is position sizing, because this also leads to your risk management. If you are either, if you take up a lot of stocks, and then you are kind of over diversifying yourself in your portfolio, and then you kind of actually buying the market only, and there may not be, it may not be, it will not move, any single stock may not be able to move the needle. While if you buy too concentrated, then you are actually increasing your risk. So the studies say somewhere between 25 to 35 to 35, beyond 35 stocks, the diversification benefits quite die down quite rapidly. And I would feel 25 to 35 would be the sweet spot for portfolio number of stocks in the portfolio. And then the fourth thing is rebalancing frequency. So rebalancing frequency is nothing but how and when will you will reevaluate your portfolio. So it can be daily also for a trader, or for a short term investor. The rebalancing frequency can be daily, while for a long term investor it can be quarterly, yearly also. But for a systematic factor investing strategy to be built in, largely it will be somewhere between monthly, weekly, quarterly, at least. Because especially for momentum, there are studies which says that if the rebalance frequency till monthly is okay, beyond that the momentum factor it starts dying down, and that may not be captured properly if you wait beyond monthly. And that intuitively also you'll understand something which has gone out of momentum, you can, it'll probably, if you wait till quarterly, then that may not be so much helpful. And then you have to define your exit rules. And obviously, this is one of the most important aspect of doing any investing strategy. And mostly that is one thing which I would feel is the most least talked about thing on the in investing, and when is basically when to sell and what when will you sell, or so this is also something which as a market structure we are also to be blamed. Nobody is going to a fund manager and asking him that what have you sold recently and why. So the fund managers are also always talking about what they have bought, and the questions are also asked to them why they have bought something, and nobody's asking why they've sold something. And so no, a lot of time there is inordinate amount of focus on buying and buying decisions, while not so much focus being done on the why why certain thing stock has been sold. And that's the reason there are studies which says that a lot of underperformance in for institutional investor and for retail investors comes in at the time of selling. They do very well at the time of buying. The stocks added do tend to do well in the near as compared to the existing portfolio, but the stock sold because whatever, there's no defined rules for the stock to be sold, they tend to underperform the after their exit. And this so these are the five things which needs to be defined. Now let's look at a sim and the so beyond that, I think let's come to back testing later. Let's try to first see how a simple momentum strategy would look like. So obviously universe, you can have your database, and that can be the universe, all the stocks in the then you, let's say you define your frequency, probably monthly you will define. And then entry exit rules can be as simple as I will pick the top 10 or 25 stocks which are ranked highest in terms of 12-month returns. I'll invest in those 25 stocks. And at the end of the month, I'll again relook at these stocks. And I will continue to hold the stocks which are, let's say, worst rank held was 15. So I will not exit if they go out of the become 11th ranked. So to reduce the churn, I will give it a bit of a leeway at the time of exit. So I'll hold it till the rank is 15. And once the stock is beyond 15, I'll exit that and enter the stocks which are among the top 10. Right. So these are the kind of simple rules where you which can help you build a simple momentum strategy. And there can be multitudes of various methods to do it. And then position sizes can be as simple as I'll start equal weighted. So all 10 stocks, 10% each I will buy. If there are 25 stocks, I'll buy 4%. If a stock, and then I will say I will not rebalance to equal at every frequency. I'll let the winners be run as, and that's a good strategy to have, that you kind of only rebalance after at least most of the institutional investors, and for retail investors also, it's suggested that above a certain percentage of portfolio, it's better to rebalance that stock. But at least let your winners run to a certain extent, and not rebalance it to again to a equal weight at every frequency. Now, after you've done a lot of factor investing strategies is through quantitative, right? So it's all numbers, and there's a lot and for at least for institutional investors and for a lot of retail investors also, there's importance to doing back testing to your strategy, at least to identify what is working for you. And the certain parameters which I'd like to cover, and which is of importance in while doing back testing, is that first and foremost and most important is your data should be quality should be very good. So it should be adjusted for split, bonus, survivorship bias. So it should not be that the stocks which are delisted goes out of your data and you don't have that data with you. So your data vendor should be very good, and the data period should be very long. So you should not, the 5 years, 10 years data may not be very helpful. In India, at least we don't have a very long term data. Only the data quality data is only available post 2005. So at least from 2005 till now, you should have the data. Now, return parameters, uh, for at least for an investing strategy, focus on long term returns. You don't check the drivers for returns. Maybe it's very too concentrated. Let's say one stock has driven all your returns in the, I mean, let's say for a 10-year period. then there are chances that you don't want to do that strategy, because it may happen that you miss that stock, right? So from that perspective, if it's very too concentrated, or the returns are coming from illiquid stocks, which you may not be able to execute at a scale, that may also be a concern, and that strategy may not be applicable to you. Uh, and then obviously you try to check your strategy across risk parameters. How much is the drawdown? So there can be a lot of strategies which have given a excellent returns in the longer term, but with very sharp drawdowns. And but that strategy may not be at least something which may be able to, you might run your personal money on that, but you will not be able to run public money on that, because for the simple reason that the investor or the client may not have the same kind of faith in you, in at least when then there is a sharp drawdown. So you will, so any strategy will have this interplay between trying to reduce maximum drawdown while increasing the return as much as possible. So this fine balance between risk protection and return generation is very, very important. And I'm not so much of a fan of optimization. There are obviously backtesting involves a bit of optimization, but what happens if you over optimize, there is a chances of risk of curve fitting. Now, uh, I'll probably move to so there are tools available, especially coding, Bloomberg, ME Broker, Trendline, and then the way to simple way to run a portfolio live, that's why I wanted to cover. Like obviously most of you have heard of a tool called Screener, and there the Google Finance also. So what you can do is, if let's say you want to run a portfolio of, let's say, momentum stocks, right? So you can just go into Screener and select stocks which have given the highest 12-month returns. So I'll just show a quick, let's say, a simple rotational strategy. So I'll just do through 1 year return. So let's say I select top 25 stocks. Obviously, you'll filter for certain things like volume, and you might have a market cap structure. And let's say you select 25 of these top stocks which have highest returns across last year, and that is your portfolio. Uh, uh, that is your portfolio, and you can then what Google Finance does, it helps you run that strategy in a very simple manner, where you can track a lot of things. So you can just put in the NSE or symbol for those stocks, and start tracking that portfolio in Google Finance, right? So let's say I created this portfolio for this webinar on 18th November. I selected stocks which have done well in the last 1 year, and then I'm tracking their performance. So it overall, the portfolio from last 2 days, or last 1 day is actually done 2% up. And you can actually compare this against various benchmarks using so all using Google Finance, which is a very simple tool. If you search on Google, you'll find various formulas, and this will be the easiest way one can, at least if you're not able to do back testing, you can run 2 3 4 of your strategies, whichever your hypothesis is, and run it at least using live data without putting in money. The easiest way is obviously to put money, and that will make you more serious about it. But if you don't want to put in large sums of money, at least you can run professionally using and track your performance portfolio live, and maybe share with others and how you are doing. And that may be one of the easier ways. Now this will so you can compare, and you can actually track your NAV using this. Now that's all from my side. I hope this webinar was useful for the listeners.
Thank
Over
you
to you.
so much, Kshitiz, for sharing your experience with us today. It was insightful to listen to you, and I would say that for a while the Google Sheet and the screen sheet was not visible, but you've shown it, so it's fine. A lot of questions, and uh, maybe like a little bit, I would say, advance notice for the audience that we will probably extend the duration of the webinar by 5 minutes so that we can take up more questions, because there are a lot of them and I don't want to disappoint the participants. So let's quickly jump onto the questions which we have. This first question which we have from Ing Yung Lee, and the question is, from a risk management perspective, could you shed some light as to how you stress test your portfolio? And do you also form your own factors using variables like global inflation rates, credit spreads, global PMI, and so on?
Yeah, so first covering from a risk management perspective. So ways to do it is, obviously, you take up a lot. You can have your own risk ratios, right? So the most popular one is Sharpe ratio. My personal favorite is maximum drawdown. So I'll try to have my portfolio in such a way that the maximum drawdown doesn't cross a threshold. So I'll try to build in certain risk managers. So, for example, in India, we saw a very sharp fall in 2008. So most of the portfolios, without building in any risk management measures, will have a very sharp fall in 2008, because the market self fall by more than 50%. So the most of the long only portfolios will fall more than that. Until unless you're running long and short, I think that's obviously one of the very simple ways to deal with such large falls. But if you're only a long only investor, which is most a large part of the market is, you will try to bring in, at least maybe you will try to build in measures where you can actually go to cash or reduce your position. So the ways to do it is, obviously, either you exit fully, or one way is that after a threshold is hit, you exit your portfolio fully and bring to cash. The second way is that you built in reduce your position size after a threshold is hit. So one way is that. The third way is that you kind of, if you're running a portfolio, once a threshold is hit, you kind of increase your rebalancing frequency. Let's say you're rebalancing at a monthly frequency, you increase it to weekly, daily, maybe even. And then once that threshold corrects itself, you go back to monthly. Then the fourth way, or at least these are all I'm thinking aloud. And fourth way is that you kind of what you do is that once you have reduced your position size, or let's say once you exit something, you don't buy it again, at least till the time that threshold is hit. So at least you'll start increasing your at least cash position. So these are all technical in that sense. And then there can be fundamental ratios also. So the investors may try to build in, let's say, a valuation ratio into it. And let's say the market crosses a certain valuation metrics, I will try to reduce my position size, or for that matter, the overall cash position may increase. But there are ways to do it. And then obviously the other very simple way to do is that you buy. Most of these, what we have seen is that it's actually, until unless there is a very sharp event, or very Six Sigma kind of event, it's not so productive to go into cash so frequently. It's better, if you want to do a risk management, do it outside your portfolio, in the sense, not tinker with the strategy so much for that. Use maybe a option route to actually buy some puts and protect your portfolio. That may be even cheaper, because what happens is that anything you want to try to build a risk management major will also have a corresponding impact on your return. So the returns will also correspondingly will have a tendency to go down.
Sure.
Yeah.
Thanks,
And
Kshitiz. Yeah, carry on, carry on.
no, I think the other one was macroeconomic factors. So personally, I don't do so much. But obviously, if you look at it, macro factors they are also factors, right? So in the sense, you can look at correlations of various such factors, and try to build it in your portfolio. And there are macro investors, obviously, trying to do that, looking at what Fed is doing or central banks is doing, inflation, how data is coming in, uh, or maybe, let's say, how the housing market is doing in US. All these factors can be built in your portfolio. And at the end of the day, it's all data. So yeah, all of these can be played out as a factor.
Sure. Thanks, Kshitiz. Next question is from Isha Palshikar. A very simple question, like how do you define low size? Any specific definition you have in mind for a small cap or mid cap? Like how do you do that?
No, I think, see, it's a very it's not, and it's a, there's no per se a defined rule for it. You can select whatever. So SEBI has a rule, maybe that you can adopt anything you want to. So basically you have to classify certain, you can select mid and small cap stocks, and that may be, and so obviously as this, in size you can have even even smaller, with a certain kind of risk parameters built in, you can probably may be able to outperform even more, right. For example, maybe liquidity, maybe volume will be a factor. You can't go and the size of AUM you are managing, that also defines the size you can play in. So for an institutional investors, the nano caps may not be applicable. So that may define your size. So as a beginning investor, you may start with as low as possible in the curve and may try to harness that size factor, keeping in mind obviously certain risk parameters. But as the AUM grows, or maybe if you're managing public money, there are certain higher risk associated with small size which you have to take care of.
Thanks again. There is a generic question, and it's from Anurag Sen Gupta. Do you think behavior of individuals play a more important role than fundamentals? What's your take on this, Kshitiz?
No, definitely. Like for example, as I said, a lot of these factors are there because there is behavioral patterns in investors. Most of the time, a lot of investors have behave in a certain way, and that's the reason certain, I would say, the market is not so efficient as the efficient theory would suggest. And there are all these factors are anomalies to efficient market theory, right? So in the sense, why is there, otherwise everything should be completely be explained in the price, and why do you, a certain factor is able to give out performance, is because there are inefficiencies in the market, either through market structure itself, let's say because there is inordinate amount of focus on buying, as I said, then or there is inordinate amount of focus for management doesn't have any, I would say, incentives to actually promote bad news, right? So they are more incentivized to promote good news. So that's the reason good news may be propagated more, and there is overreaction to good news while underreaction to bad news. And all these things kind of behaviorally play out in the market, and a lot of it is decided, and at least these anomalies are decided by behavioral patterns. But overall, if you see, if you're for a long term, if you look at as a so these are all alpha, right? So in the sense, but a market factor is still a large part of it, so you cannot wish away the market factor. So there's still a market factor being driven. So the market itself would be driven by what the underlying is. So behavioral patterns can only dictate the excess performance, but the overall, the average performance is still driven by fundamentals. Obviously you can't say that everything is driven by liquidity and that is the only thing which will define the market. The fundamental will define the market, a large part of it. But if you have to outperform it, maybe you'll have to try to build in a certain other things over and above it.
Sure, I think that's fair. This is a question which a lot of people had. Of course, you mentioned Screener and Google. Any other sources which you would like to mention for our users and audience to probably look at, and where they can find data to run their own factor strategies?
So, so data-wise, there are data vendors. The most popular ones are the most quality ones were Global Feeds, Reuters. But there are local India for Nifty, at least there is Get Bhav copy, which is free, and you can download all the, but that is not adjusted for, like I said. So that manual work has to be done. But there are vendors, smaller vendors, which are Veratech, and there are 2, 3 more StockSense, which will provide you data. But obviously the quality of the data would be slightly lower. But for an investor, at least, if you can, for a trader it might be an issue. But for an investor who is focusing more on a long-term investment, those data may still be helpful. But obviously, institutions will be looking at more from a Reuters or global data feeds or those kind of data vendors. That's where the data comes in. And as I said, for back testing, I think I had shown sorry. There are tools available for back testing. I'll not read through them, and the viewers can see it on the screen.
Sure. Of course, I would have wanted to continue this conversation, but we are already 5 minutes past the scheduled closure time.